Hello, this is Bill Scheid from Applied Finance Research with an overview of 97 years of PMA SPY performance from 1929 through 2025. What we have here is a backtest from EdgeRater. We are using the S&P 500 as our underlying data set, and of course the S&P did not exist in its current form prior to the 1950s, so we're using data reconstructed by TradingView. These are month-end prices, and this analysis does not include dividends, slippage, commissions, or taxes. The equity curve on the right shows us the performance of the system in the dark colored line versus buy and hold for the S&P in the light blue line. The buy and hold for S&P returned 5.95%, whereas PMA had a CAGR of 6.24%. Buy and hold had a maximum drawdown of minus 84.1%. That was during the Great Depression. And PMA had a maximum drawdown of only minus 43.1%. Buy and hold had an MAR, that's the CAGR to maximum drawdown, had an MAR of 0.07, whereas PMA had an MAR of 0.14. So essentially, the system cuts the maximum drawdown roughly in half with slightly higher CAGR and an MAR approximately 2 times better. Now let's take a look at some detailed results, and we'll get into some Tharp think analysis here. So the SQN for the system over this period is 6.04, and the SQN 100 is 2.23. So by the standard SQN calculation, Dr. Van Tharp would say that this is a superb system, whereas by the SQN 100, which adjusts for the number of trades, Dr. Van Tharp would say this is a good system. The system had 736 positions traded during this backtest period with a win rate of 62.2%. It had a win-loss ratio of 1.08 and a profit factor of 1.8 with an expectancy of 0.88%. Now let's jump into the year-by-year picture. Year by year, the annual return of buy and hold beat PMA in 71 out of 97 years. Yet, over the full 97 years, a hypothetical 10,000 in PMA grew to roughly 3.57 million, while 10,000 in buy and hold grew to 2.76 million. Now, how is that possible? How is it possible that buy and hold could beat PMA in 71 out of 97 years, and yet PMA still produces a higher return at the end of the run? The answer is when PMA outperforms, it outperforms big. The average advantage in the years where PMA beat buy and hold was 12.7 percentage points, whereas when buy and hold outperforms, it outperforms small. The average advantage in buy and hold winning years was 5.6 percentage points. So where does the edge of the system actually come from? Well, in years where buy and hold fell more than 20%, it averaged a loss of 31.1%. In those same years, PMA averaged a loss of only 1.0%. Buy and hold had 17 years where the maximum drawdown was worse than minus 20%, and PMA had only 3 years. The worst single calendar year for PMA was minus 21.2% in 2022, whereas buy and hold had the worst single calendar year of minus 45.6% in 1931. The 5 biggest PMA outperformance years, where outperformance was greater than 20 points, were all bear market years, and those were 1930, 1931, 1937, 1974, and 2008. PMA was flat in 4 of those 5 and barely down in 1937. So the crisis years are where the system earns its keep, which proves the point that often the best defense is a good offense. Now, as good as these numbers are, Let's also be realistic and talk about what the system gives up. PMA lagged buy and hold by more than 10 percentage points in 14 of the 97 years. And these years were almost all sharp recovery years following deep sell-offs. So some examples are 1933, 1975, 2019, and 2023. PMA misses part of the bounce when the recovery starts because it's still in cash. This is actually the structural cost of the bear market protection that we just saw. Crisis year capital preservation and recovery year underperformance are actually two sides of the same coin. I think one of the most interesting questions to ask in this analysis is, how does PMA reshape the distribution of returns, and how does that affect the experience of using the system in real life? Well, PMA does not shift the return distribution to the right, even though it has a higher total return across the 97 years. The average annual return for PMA is 7.1%, whereas buy and hold is 7.7%. What PMA actually does is it reshapes the distribution by compressing variance and reducing large losses. The standard deviation of annual returns for PMA is 13.3% versus 18.8% for buy and hold. As we saw earlier, the worst single calendar year for PMA was minus 21.2%, versus buy and hold minus 45.6%. And we also saw that for years with an annual maximum drawdown worse than 20%, PMA had only 3, whereas buy and hold had 17. So the edge is not necessarily in a higher average return per year, it's more reliable return with dramatically less downside. Less variance in return means that the system is easier to plan with. Withdrawals, contributions, and projections all become more predictable because of the more reliable return. Less downside means less emotional and cognitive stress when operating the system. It also means less damage to capital if you're making withdrawals during a drawdown, since you're selling fewer shares at depressed prices to fund the same withdrawal. Also, less downside makes you more likely to stick with the system rather than abandon it at the bottom of a drawdown. At the end of the day, it doesn't matter how good the backtest is. If you abandon the system in a drawdown, it doesn't return what the backtest says, it returns a loss. This is Bill Scheid from Applied Finance Research. Thank you very much for watching, and happy investing.